Everybody, it's Craig Moser, Maestro Wealth Advisors. It is the 12th day of October already, 2021. Wanted to briefly review the markets and chat with you for a little bit. So I have to say, this is me trying to smile. I did a video shoot in Kansas City last week. Man, I was the most boring, sleepy guy you ever saw. So I'm going to try and smile to do this. Anyway, don't want to be ridiculous, but anyway, let's share a screen here and talk a little bit. Okay, since I have this already up, let's go ahead and talk a little bit about what I think is happening here. So this is an exchange traded fund from BlackRock, and it buys 20-year Treasury bonds. So these are long-term, long-dated U.S. Treasuries. And looking from left to right, obviously, you can see the chart pattern is not an up pattern. It's kind of a very struggling sort of pattern. And if you look at the ranges, you can see over here that at one time we were at about 163 back a year ago. We went as low as, around 134, 133, something like that. Tried to rally back up. So what you should be seeing is the industry, the market for the bond markets, reacting to comments from the Fed chairman. I am going to taper. That means I'm going to raise rates. I'm going to quit supporting buying these types of bonds. So hasn't done it yet, keeps talking about it, and the market reacts to it. So I wanted to pull this over. Actually, I'm just going to do a screen share for this and show you this. And this is why bond prices and the interest rates, basically have an inverse relationship to one another. So if you bought a bond when it's first issued, the term is called at par. So let's pretend that we bought a bond for $10,000 just to have something to talk about. And let's say that the interest rate on this bond for conversation is 1% a year. So typically we'll get paid 2 times a year, half of it each time. And then at some point in the future, this bond would mature. So in many ways, it has characteristics similar to a CD. But the thing that's not similar is that when either bond prices, interest rates rise or interest rates fall, those impact the prices of the bond. So what that means is that if interest rates go down and you have already purchased a bond paying an interest rate, and then they drop rates, the price of your bond will go up some. If interest rates fall, the prices rise because you have a set payment, and it probably is higher than before the rates, went down. The same thing can happen when interest rates rise. So let's say that the Fed chairman says, I'm going to raise interest rates. Let's say over the next 3 years, he raises the rates to 4%, like they did about 3 or 4 years ago. Well, if interest rates rise, what you own goes down in value from a price perspective. You still get your payment. If you bought the individual bond, eventually it will mature. You probably should do nothing. But if you have a mutual fund, or, to a lesser extent, an exchange traded fund, those types of investments, they're perpetual. So what happens is that they never sell. And so you're in a position to where if rates go up, you will own something that goes down in value. So bonds typically in our past have been used as a defensive player on your field. Might not be the same right now. Okay, so let's look at what we call the stock market. The S&P 500 is the easiest proxy. It has a broad smattering of large cap growth. So you have all the Facebooks and Apples and Amazons and Googles in there, but you also have other stocks such as McDonald's and Honeywell and Travelers and so on and so forth. So an amazing run this year. I mean, when you look at what has happened from a year ago to today, 16 something percent, maybe 23%, something like that. It's been a good run. So a lot of money has been made in the stock market. Now, I've often argued that a lot of this is is capital creation, where they're printing money, combined with low interest rates. But we can debate that sometime offline. But at the end of the day, if we're looking at a rate of return over the course of 12 months, it's pretty strong. And you can't argue with success. One thing that I'm noticing here, when we have drawdowns, okay, short drawdown here, very short drawdown here, and then from right here, which was last month, about the 2nd of September, seems like that has been at least a short-term market top. I'm not calling tops, I'm just saying, looks like it. So let's talk about it. You can see the market from here to here or here has started to make lower highs, okay? That typically is a market chart pattern you should pay attention to. So let's see if I can snag this and use it again. Probably can't, but be nice if I could. Can't, not going to mess with it. I'll just do another. And let's say that we look at this from a chart perspective and draw a line. It's like, okay, so now from that market top, maybe down 3, 4%, depending on what point you're using to measure from, to maybe 6% decline from the market top, not from the top from the beginning of the year 12 months ago, but from the last market top. So it's something to be attentive to, that perhaps we're starting to see a little bit of sell volume here, meaning that maybe the market's tired. I don't really see anything leaping off the page saying danger and disaster outside of what we saw 2 or 3 months ago. So when you look at what occurred 2 months ago, I mean, are we really having more supply chain issues than we had then? Probably not. Are we having more labor problems than we had then? I don't see that either. So I'm not in a panic. I'm just paying attention to the fact that we're making lower highs. And then, the argument might be also that our lows are starting to tap in a little lower. So pay attention. No alarm bell, just sort of bringing it up to say, this is something that we see, and just wanted to be just make you aware of it. So let's look at something else. Let's look at our competitors overseas, if you will. Emerging markets, that's sort of a big group. Biggest player in here is China. And you can see that for the year, the market top for them was around February of last year, of this year, actually, I'm sorry. So you can see February was a market top, and we've seemed to start making again lower highs. So is this a deceleration of a growth pattern, or is it just short-term volatility? We'll find out. We'll pay attention and see what's happening. Europe, Australia, and the Far East. A different chart pattern than ours, but everybody seems to have tapped out, around last month, depending on what you call the market tops, between 9.2 and say 9.15. Seemed like that was at least the short-term top that we put in there for the markets. Selling pressure, if you look down here, these are volumes. And you can see pretty high sell volumes for a few of those days. And when they were bought back, it was less vigorous. So people are trying to buy the dips, but starting to become a little more nervous. This is my opinion, of course. So where is strength in the market? So let's look at a few of the sectors. I wanted to do this last time and didn't, but we will today. Let's look at technology, which has been the heavy lifter for quite a while. So this is a 1-year chart. You can see that's a nice pattern, although getting some swoons and dips here lately. But if you look at it for 2 years, the magic appears. I mean, it's been amazing for technology. So COVID really didn't hurt technology at all. Whereas if you look at, for example, utilities, electric utilities and the like, oil type things, came back, decent chart pattern, but is struggling right around here, which this blue line right here is a simple 200-day moving average, if you're trying to understand what I have on my page. So what we're really seeing is the utility sector, sort of going sideways. If you look at where we were 2 years ago, if you look at where we are today, sort of a battle. You know, we're seeing uptrends and downtrends, but really not making an uptrend that's sustainable at this point. Let's look at energy. Good one to look at. So energy, and I'm looking at back 2 years, energy really had a hard time, but now energy is really the strongest sector for the last month or two. So as the prices of the commodity have gone up for oil, obviously that has pushed the oil people that search for oil, not so much the pipelines, but some, but energy in sort of aggregate has improved a whole lot over the past 3-4 months. The easiest way to say it, made a big bottom and has gone up. Now I'm using something that it does not reflect the price of oil. I just want you to see sort of how this oil future ETN that we use sometimes. This is the United States Oil Fund. So this thing buys oil futures. Okay, it's not reflective of the actual price of oil. So if you go back to January of 2020, oil prices, at least for the futures, were pretty high. Dropped like a stone because COVID said, hey, there's probably no demand. And since then has been a pretty steady incline. Oil prices today, by the way, pretty daggone high. I was looking this morning and about $82 for a barrel of oil. That's a whole lot better than the $26 a barrel that we saw somewhere in here. So if you are in the oil business, you're starting to decide whether or not you open up a wellhead and pull some oil out of the ground, because guess what? You can make a little bit of money on it now. And so it's a two-edged sword for the oil industry. Oil price is up, the consumer pays more. But if you're in the oil business and you're pulling it out, the commodity out of the ground, hey, not so bad. Let's look, for example, at materials. So that should be an interesting chart. You can see basic materials, things that you would buy, you know, like aggregate for your roads or what have you, has gone up and again peaked and is now starting to move a little bit sideways. I would imagine some of this is supply chain issues and what have you. If you look at staples, so my easiest way to define what a staple is toilet paper, something like that. You're not actually buying the commodity. These are the companies that produce it. So Procter & Gamble, Kimberly-Clark, so on and so forth. So staples, all of these have gone up pretty well over the last 2 years since the negative hump we had with COVID. Financials. So the banking industry has started to perk up. How come? Are they making more money on interest? No. But if interest rates go up, that seems to be a positive for the lenders because their margins can improve some. If you've looked at the yield that you get on a 1-year CD, it's pretty rough on the major banks. I mean, you're just not able to get paid because they don't have any interest to pay you. But nonetheless, a lot of people still buy those CDs. It's just a safe place. It's not a place you can make any money. If you looked at industrials, and I'm using Fidelity's indexes for these, industrials, again, sideways, this would be your Caterpillars, those types of things, companies like that. Honeywell, so on and so forth. Let's look at discretionary. So I get argued with on what I call discretionary, but discretionary is I can decide to buy it or not. So this could be, do I pay for a cruise? I guess that's entertainment, not sure. Do I buy a Ford pickup truck? Those types of things, I can decide whether I buy that or not. It's not a necessity like the staples are so much. Telecom. So what you should be seeing in all of these charts is that we ran up, looks like we peaked, and now we're sort of doing this sideways, trying to figure it out thing. Healthcare peaked right again. That's sort of the same place I've been talking about, 9.2, 9.3. And since then, it's been on a short-term pullback. We'll see if this rectifies itself, corrects, or if this is the previews of coming attractions. Guess what, guys? I don't know. And nobody else does either. They're all guessing. So you just have to have a way to react to it. Gold, and then I'm going to quit for the day. Gold, everybody says, should I be buying gold? And my answer is only if it's going up. So far, it's not. Lower highs. So we pay attention to gold because it's something we can buy and see appreciation, but it's not something that we just buy. So it probably will do better if we see the market shudder some. People seem to run to gold, so be attentive to that as well. All right, I don't want to talk too long because it gets boring, I think. But if you have questions, you can call us at 336-448-1086. I put a lot of this information on our website, which is maestrowealth.com. If you want to go there and dig around in some of the stuff that we have put for research and some of the things that we have written, the videos, the podcast, be happy to share with you. You're under no obligation to us. So help yourself if you will. And with that, I'm going to wish you a great October. Be safe, and we'll talk to you later.